All right, let's talk about Meta. The stock has been all over the place lately, sending some seriously mixed signals. We've got our hands on an analyst report that's basically pointing in two directions at once. So today, we're going to play detective. We're going to break down the clues and try to figure out what's really going on under the hood.
And this really gets to the heart of it, right? This is the big question. Meta's price has taken a tumble from its recent highs. So, is this a giant red flag, a warning sign telling us to run for the hills? Or is this a hidden opportunity, maybe a chance to get in? That is exactly what we're here to investigate.
Okay, so here's what makes this so interesting. The analyst's verdict, right up front, is a neutral signal with low confidence. Think about that. That's not a buy, it's not a sell. It's basically the analyst saying, I'm not so sure. It's an admission of real uncertainty, and that tells us we've got a genuine puzzle on our hands. So let's put on our detective hats and start digging into the evidence.
First up, clue number one, we've got to decode the trend. What's the big picture here? To do that, we're going to look at the stock's price compared to its own recent history, and we'll use a couple of key moving averages to get our bearings. This will give us a baseline, a starting point for our whole investigation.
And boom, right away, you can see the central conflict. It's a tale of two trends. Look, the current price has dipped below its 50-day average. Now that's a classic sign of short-term weakness, right? But, and this is a huge but, it's still floating above the 200-day average, and that's our proxy for the much bigger, longer-term trend.
So what does that actually mean? Well, it means the chart is telling us two totally different stories at the exact same time. The short-term story, it's bearish. The recent momentum is definitely negative. But the long-term story, the bigger picture, that's still positive. This clash, this conflict, is exactly why the analyst is feeling so uncertain. It's a classic tug-of-war between the bulls and the bears.
All right, on to our next clue. Let's see if we can get a feel for the market's pulse. We're going to look at something called momentum indicators. Now, you can think of these as tools that try to measure the market's psychology, its mood. They help us understand how fast and how far the price has moved, and that can give us a hint about whether the sellers are getting, well, tired out. But before we dive into the data, we need to get one key concept straight: oversold. What does that mean? Super simple. It's when a stock has been sold and sold and sold again so aggressively that the selling pressure might just be running out of gas. I love this analogy. Think of it like a pendulum that swung way too far to one side. It's got to swing back eventually, right?
Okay, Exhibit A for our momentum case, the Relative Strength Index, or RSI. It's clocking in at 34.17. Now, for context, a reading below 30 is what traders usually call oversold. So being this close, well, it's a pretty strong hint that the recent selling spree could be getting a little long in the tooth.
But here's the kicker. It is not just the RSI. We've got a whole chorus of other indicators all singing the same tune. The stochastic oscillator, deeply oversold. The Williams %R, it's at an extreme low. The price has even poked its head below the lower Bollinger Band. I mean, all of these different tools are basically flashing the same warning light. When you see this much agreement, the oversold argument gets a whole lot more convincing.
Okay, so we've looked at the trend, we've taken the market's pulse. Now for our third and final clue, let's identify the key battlegrounds. These are the actual price levels, the lines in the sand, where the real fight between buyers and sellers is going down. And whoever wins this fight is probably going to determine what happens next.
And the report gives us a really clear map here. The immediate ceiling, what analysts call resistance, is sitting right around $726. The immediate floor, or support, is just a bit over $710. And hey, if that floor breaks, everyone's going to be watching that big round number, $700. That's a huge psychological level. These are the zones that matter right now. And remember, these aren't just random numbers on a screen. They are real battle lines. If the buyers, the bulls, can get ahead of steam and push the price past that resistance level, it's a huge sign they're taking control. On the flip side, if the sellers, the bears, manage to smash through that support level, well, that's a pretty clear signal that the downtrend has more room to run.
Okay, so let's recap our evidence. We have a conflicting trend. We have a market that looks deeply oversold, and we have very clearly defined battlegrounds. So now, the moment of truth. Let's put all these pieces together, and what you'll see is that this evidence doesn't point to one single certain outcome. Instead, it paints a picture of two very different possible futures.
And this is the whole thing in a nutshell. The trend is whispering in our ear, hey, be cautious. But at the same time, all those momentum indicators are shouting,
A bounce is totally possible. This conflict, this contradiction, this is the heart of the dilemma. And it's exactly why that analyst report had that low confidence rating.
So let's lay out the two potential scenarios, the two game plans. On one side, you have the bullish case. It's pretty simple. If buyers can push the price up and over that 726.55 resistance, the next target on the map could be 740.66. Then you have the bearish case, just as clear. If sellers break through the 710.18 support floor, all eyes are going to turn to that big psychological level at $700.
All right, we've looked at all the clues, we've weighed the evidence, so what's the analyst's final take? How do they actually resolve this fight between the trend and the momentum? Let's get to the final verdict.
And here it is, bringing it all together. Step 1, acknowledge reality. A short-term downtrend is in place. Step 2, but you can't ignore those really strong oversold signals that are screaming a bounce is possible. And step 3, remember the big picture. The long-term trend is still technically positive. See? When you lay it out like that, it's pretty obvious why the call was neutral with low confidence.
And this quote from the report, this is probably the single most important piece of advice here. With all these conflicting signals, the recommendation isn't to try and be a hero and guess who's going to win. No, the advice is to be patient. Let the market show you its cards. Wait for more clarity before you go making any significant moves.
So we've come full circle. The final verdict here isn't a bold prediction. It's a strategy. And that strategy is to simply watch those key battlegrounds we talked about. The answer to our very first question, warning sign or hidden opportunity? Well, that answer will likely reveal itself when the price finally makes a decisive break, either up or down. That will be the clue we've been waiting for.
And this really leaves us with one final big question to chew on. This whole deep dive into Meta is a perfect case study in market uncertainty. Because when the data is this messy, this conflicted, you have to ask yourself a really fundamental question. What's the bigger risk here? Is it jumping the gun and acting too soon on an incomplete picture, or is it waiting too long for perfect clarity and maybe, just maybe, missing the entire move? That right there is the puzzle every single trader and investor has to solve for themselves. Thanks for digging into this with me today.